Introduction. Welcome to our financial accounting series. In today's video, we'll be discussing the principles for the recognition, measurement, presentation, and disclosure of leases as per the International Accounting Standard, IAS. Our aim is to help you better understand the effect of leases on an entity's financial position, financial performance, and cash flows. So, let's dive in. Scope and objective. The IAS requires entities to apply these principles to all leases, with a few exceptions like leases for natural resources or agricultural assets. The standard also allows for recognition exemptions for short-term leases and leases with low-value underlying assets. Identifying a lease. At the inception of a contract, an entity must assess whether the contract is or contains a lease, which conveys the right to control the use of an identified asset for a period of time in exchange for consideration. Separating components of a contract. For contracts containing lease and non-lease components, entities must account for each component separately, unless they apply a practical expedient for certain cases. Lease term. The lease term is determined as the non-cancelable period of a lease, along with any periods covered by options to extend or terminate the lease, considering the lessee's reasonable certainty of exercising these options. Lease recognition and measurement. Entities must follow specific guidelines for recognizing and measuring lease components and non-lease components. Lessees have to allocate the consideration in contracts to these components, while lessors use IFRS 15 to allocate the consideration. Lease modifications. Entities must reassess lease terms and modify lease accounting in case of significant events or changes in circumstances that affect the lessee's certainty of exercising extension or termination options. Conclusion. The IAS provides a comprehensive framework for accounting for leases, helping users of financial statements to apply IFRS 16. Thanks for watching.